I am so pleased to welcome Jim Grant to the program, to Money Moves. Of course, Jim Grant, the widely followed, widely respected Grant's Interest Rate Observer. Jim, you have been founding, well, you founded it back in 1983. And
1883.
1883. All right, I just missed on that one number there, but you look remarkably well, remarkably
You should have seen me when I was 100. It was fabulous.
In just fit fighting shape. Julie went through how the markets are a little bit calmer today, at least if we measure by Italian bond yields. French yields, though, are climbing. Actually, I saw a pretty funny tweet this morning that said, put down the cannoli, pick up the croissant, sort of, here we go. But in all seriousness, I mean, Italy is a big problem, right?
Well, it is quite something to think about, that the world hangs by some of these threads. By the financial probity of Italy, that's one thread by which it hangs. By the determination of Greece to implement austerity measures, that's another thread. And by the responsibility of our money-spinning central bankers, that would be a third thread. These are very slender threads indeed. I think the question to me is, what will the European Central Bank do next? I mean, it has, in fact, expanded its balance sheet mightily during the Trichet regime. We have a new leader, and we have a new imperative, it would seem, for the Europeans to do what they do so well, which is to print money, and I dare say that's what's going to happen next.
You feel like is going to happen, because we already saw the ECB loosen up a little bit last time around, which was somewhat of a surprise.
Yeah, I mean, I don't think these Italian bond yields fell on their own. I dare say there was somebody in there buying them, and that somebody must have been, I think, the European Central Bank. All this raises the question of what raises many questions. One is the overall integrity of market prices. In this country, the United States, the Fed has virtually nationalized the yield curve. It has suppressed interest rates. It has manhandled the structure of rates and yields. In Europe, much the same is going on with currencies. For example, the Swiss National Bank is expanding its balance sheet in most unknown-like fashion at astonishing rates of speed. Over the past 3 months, it has grown at over 300% at an annual rate. So the world over, there is immense money printing, and there is a huge race to debase on behalf of the sponsors of paper money. And
Jim, you even pointed out in your newsletter that if the ECB were forced to pass a solvency test, it would probably flunk. So this is a big problem.
Well, we should say why. So the ECB shows a ratio of non-AAA rated assets of 14 point something to 1 versus 5 point something to 1 when Trichet began. Again, this is the ratio of non-AAA rated assets, and I dare say many of them are not even rated BA. Of those assets to equity, it's usually leveraged by 14 to 1. Now, what the ECB has been doing is stepping in when private money fears to tread. It has been absorbing these very dicey assets and piling them high on a not very substantial base of equity. In the private sector, we call that heading for trouble. Right, heading for trouble is a pretty good, clear takeaway. I mean, in this current scenario, that's the MF Global trade that the ECB is now implementing. Well, you joke about that to a certain extent, but I mean, hedge funds everywhere are so exposed. I mean, MF Global was exposed. Hedge funds are exposed to what is going on. Well, hedge funds at least mark to market. Right. The ECB does none of that visibly. Central banks the world over get a pass at the most basic kind of financial hygiene. The New York Fed is leveraged more than 100 to 1. The Federal Reserve System as a whole, starting this year, in disclosure virtually unnoticed in January, said that from now on it will not charge mark-to-market losses, if it has any, against capital, but rather kind of keep a running tab with the Treasury. So watch what listen to what they say, but don't do what they do. Otherwise, you too will be broke. Jim, we just heard from Lizzie there. She's in D.C., but she was talking about Bernanke's comments at a base in Texas, which is a little bit surprising, or at least it's not his usual venue. Well, it's good that he gets out, but his appearance at a U.S. Army base does serve to remind us that the U.S. dollar is mandatory. You must take it in exchange for the discharge of debt. This is a fiat currency. It is government issued, just like those uniforms where we saw. And it is, you know, it's.
So to you, it's not so strange that he would be there. It's stranger that he doesn't do it more often.
You know, Rick Romney, I can't remember. He can't remember. Yeah, right.
I was just going to say he can't remember a few things too. So it's all right. You're on.
I noticed he didn't say he was going to abolish the Defense Department. The Defense Department is in fact related in some important symbolic ways to the Federal Reserve System.
Oh, of course it is. And actually, Jim Rickards is going to be on. That was the subject of his new book, Currency Wars. So we're going to talk about that. We even have movie clips. We didn't get the one he wanted, which was Dr. Strangelove, but we got in War Games. But it is about exactly that, this intersection between financial world and military world, at least defense. But prior to our discussion on Europe, you and I were just speaking offline about farmland and these investments in farmland. And because we're an alternative assets show, I get to talk about things like farmland. But it's pretty cool. I mean, there is a lot of interest in farmland, in buying up farmland, and for a few different reasons.
Well, we've been following this for a while, and the story on farmland is that it trades most infrequently. It is a very illiquid asset. It is a very popular asset, a lot of money chasing it. Now, the richest corn ground in America is situated in Iowa. And some land in Iowa recently changed hands at almost $17,000 an acre. It seems, I can't remember if it was 16 or 17. But the yield on a rental basis, if you were to rent this land to a farmer who would then grow corn on it, the rental yield is about 2.5%, 3%, depending on what assumptions you use. This is at rock bottom for rental yields over the past 40 years. So farmland, like so many other assets, is levitating in price, owing in good part, to the level of interest rates, which is to say, level of interest rates is right there, down there on the ground.
I was just going to say, it's a ground level. We could get in some farming investor.
Right, planted corn. You know, in the day when after the last deflationary farm depression in the mid and late 1980s, this land would have been trading at maybe $5,000 or $6,000 an acre. It would have been priced to yield upwards of 7 and 8%. Lo and behold, comes the passage of time, comes forgetfulness, comes the Fed's immense intrusion into our monetary lives with its so-called quantitative easing. Everyone has to own something because money itself, when saved, yields nothing. And these farmers are out buying land at hugely, well, I say inflated, so we say fancy prices for yields that you need really, really strong eyeglasses to see.
Well, what's interesting is at a conference that I was at recently, I met an investment banker who actually had recently purchased farmland on behalf of a huge consumer products company that we all know. We all use the products.
Just give us the ticker.
Just speak in code, yeah. No one will know if I give the ticker, right? But I mean, it began to, and he was saying part of it is actually to treat water if that ever becomes an issue. Yeah.
Well, there is growing institutional interest in farmland. I know.
Many reasons.
Yeah, I know, you're right. I know value-minded investors who refuse to pay $16,000 an acre for the very finest, chocolate cake quality Iowa earth. There's plenty of cheap land, by the way, in where I have some land in Schoharie, New York. I will find the zip code later.
I was just going to say, if you want to make an offer,
devastated by floods upstate New York, and some of this ground is quite fertile when not underwater.
Okay, right. There's a catch, right? There's always a catch. But also, so as an inflation hedge, I heard you say also.
Well, everything is to me at least, is attractive or not at a price. And one can think, cosmically and in macroeconomic terms as farmland as an anchor to windward against the next inflation, except you're buying it at exactly the wrong, seems to me at exactly the wrong price. Unlike gold, for example, you cannot value because it yields nothing. Farmland, for better or worse, you can go back and see what grows on it and what that price is, what the historical trend of that price has been, and you can figure out whether you've got a margin of safety. So the margin of safety is vanishingly thin in some of the richer sections of American farm ground.